It does take us to our talk of the tape, whether an overbought stock market's about to take a big-time breather. Let's ask our big-time panel. Dan Greenhaus of Solus Alternative Asset Management, Lauren Goodwin of New York Life Investments, and Kristen Bitterly of Citi Global Wealth. As you see, everybody's with me at Post 9 today. Nice to see everybody. Kristen, I'll come to you first. Is today about yields, nervousness about where they may go, and that the Fed may not cut as soon as we hope?
I think it's a little bit of a garden variety pullback. I mean, we've heard day after day that we're either touching all-time highs or within reach of all-time highs. So I don't see anything to read into today more than geopolitics resurfacing, yields popping up. And I think the question is, everyone's trying to ask, is inflation more entrenched? Is that something to watch? When you look at the backdrop, though, I have to say you have to go back to what we know is true. We know that there's $6 trillion of cash on the sidelines. We know that the Fed's trajectory from here is downward. We know inflation is coming down. And we know that earnings have turned a corner as well. So when you have that fundamental backdrop, it's actually pretty constructive for risk assets overall.
So you're still pretty bullish then on where this market can go?
And you have to pick your spots and you have to stay diversified. So we're balanced within our portfolios. But I don't see, if you were to say those four things that I just said in any other environment where people weren't waiting for a Fed cut, I think people would say that actually tees up pretty nicely for risk assets.
Well, I mean, we can probably, Dan, do without a rate cut. What we can't necessarily do with is a continued backup in rates, right? I mean, that's going to be counterproductive to where the bulls suggest this market can go. Jonathan Krinsky of BTIG says above 4.32 on the 10-year will cause some turbulence. Strategist's Chris Ferrone says the push in yields right back to 4.35, coupled with a bid to the U.S. dollar, the strength in oil, the persistence from gold. We're inclined to raise our guard here. Should we be raising our guard?
Yeah, listen, I think to Kristen's point, this comes in the context of a rally that's, call it 30% off the late October lows. You were overbought on a number of measures, not dramatically overbought, but overbought enough. And so I think when you put it all together, put that all together, certainly you might think there could be a catalyst for some level of a correction. I mentioned last time I was on last week, the distance to the 200-day moving average, not the widest ever, but fairly wide. And so is there scope here for a 5 or 6% pullback? I think absolutely, on the basis that yields are backing up. But I would reinforce, or I should say align myself with the point of view that I don't think 4.3% is some deleterious level, or even 4.4, or even 4.5. I won't buy into that idea.
Why?
The rate of change matters more than the level. Meaning, as rates adjust to higher levels right now, and we can have a separate conversation about why that is, that might cause some consternation for stocks in the context of what I just articulated. But once you settle in at 4.3 or 4.4 or 4.5, can equities not move higher? I mean, of course they can, and look no further than performance in the first quarter. The 2-year, the 10-year, whatever you want to look at, was higher by 30, 35, 40 basis points in the quarter, and stocks, whether the equal weight or the market cap weight, still had a good performance.
But stocks were moving higher because they were anticipating rates continuing to go lower, coinciding with Fed cuts coming. You can't tell me that no cuts, higher rates, and no equity is just going to continue to go higher.
Yeah, I will tell you that.
Why?
First of all, it wasn't just the prospect of rate cuts that drove stocks higher. The economy improved. A couple of months ago, first quarter GDP growth was expected to be, call it 0. Now it's going to be somewhere between 2 and 3%, depending on how the March data comes in. So the economy improved. Yes, earnings expectations have come back in, but we're probably going to beat those levels. I have to run through the numbers later. We're probably going to beat that level. I don't think that the whole reason the stock market was up, call it 5% equal weight, 9 or 10% market cap weight, is just because we were going to cut rates. So with that said, yes, if the Fed doesn't cut rates in June, or perhaps they push it out for another quarter or something, not the optimal scenario, so to speak. But if the economy continues to perform, we've come out of the earnings recession, then why wouldn't on-balance stocks be higher?
Well, maybe because rates continue to creep a little higher if the economy, in Dan's words, continues to perform. Lauren?
When I take a step back from the next couple of days, and look, we're going to have a bit of a wild couple of days. We have the jobs report on Friday. It's PMIs that have been stoking some of this concern, inflation next week. I see today's market activity as very much an inflation story, a concern that the economy is overheating, which is a concern, by the way, tactically, I agree, is the biggest concern for the market. But when you look over the next 6-12 months, I agree with Kristen. We are seeing a disinflationary process, and we're starting to see cracks in the labor market. I still expect, actually, that the labor market will weaken just enough that the Fed will be able to cut in June.
You do?
I do.